Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we delve into the latest developments, trends, and regulatory changes affecting the industry. I am your host, Steve Hamoen. As an accomplished entrepreneur and certified 10X business coach, I bring over 25 years of experience in sales and business development to the table. As the principal broker at Real Approved Incorporated, I am passionate about helping you make well-informed real estate and mortgage decisions. Whether you are a first-time home buyer or a seasoned investor, this podcast is designed to keep you informed and ahead of the curve. Let us dive right into today's docket. It is official. Canadians can now access lower borrowing costs, following the central bank's long-awaited interest rate cut on June 5th. That quarter percentage point cut, which brought the central bank's benchmark overnight lending rate down to 4.75% from 5%, is the Bank of Canada's first since the early days of March 2020. It has made floating rate borrowing products, including variable mortgages and home equity lines of credit, cheaper. In the 2 weeks since that Bank of Canada rate cut, our brokerage team has fielded plenty of questions from clients who want to know exactly what it means for their household's bottom line, and when they will feel some rate relief kick in. Here are some answers to the questions today's borrowers are asking. Question 1. Will the Bank of Canada cut rates again? When it comes to monetary policy, no one has a crystal ball. But what we do know is that the Bank of Canada's Governing Council, the team that calls the shots on the benchmark rate, are heavily data dependent. That means we can look to the latest economic numbers on inflation, gross domestic product, and jobs as clues to the Bank of Canada's next move. In particular, the central bank is focused on bringing Canada's inflation rate back to its 2% target. Any further progress on this front, for example, if the May inflation reading comes in below April's 2.7%, will help pave the way for additional rate cuts. Canada's largest lenders, as well as market analysts, currently believe we are on track for a total of 4 rate cuts in 2024, which, if doled out in quarter-point increments, will lower the benchmark rate to 4%. However, as Bank of Montreal chief economist Doug Porter wrote in an economic bulletin, while it is reasonable to expect more rate decreases, decisions will be made on a case-by-case basis. This is indeed likely to be the first of a series of cuts, although that series is not going to be a straight line down by any means, he wrote in the report. The bank's tone is a bit more dovish than expected, but each and every cut this year will require evidence that inflation is calming. Question 2. When will my rate change? Has it already? The borrowers most affected by the Bank of Canada's rate direction are those with variable mortgages, which have interest rates that fluctuate based on the lender's prime rate, which is in turn set by the Bank of Canada's benchmark rate. All lenders lowered their prime rate within a day of the Bank of Canada's announcement, with most decreasing their rate to 6.95% from 7.2%. So the short answer for this group is yes. Your rate has since changed and will be reflected in your next payment after the announcement. The way your payments may be affected, however, will differ based on the type of variable mortgage you have. Those who have an adjustable rate mortgage will see the actual size of their payment decrease at their next regular payment date. However, if you have the type of variable mortgage that comes with a fixed payment schedule, your payment will remain the same. More of it will now go toward your principal mortgage balance, rather than interest costs. Those locked into fixed mortgage rates will not see any change to their payments. However, given fixed mortgage rates have eased by roughly the same margin since the Bank of Canada's rate cut, those shopping for a new fixed-rate mortgage or coming up for renewal may be able to access lower rates than they could have before the bank's last announcement. Question 3. Will the rate cut help me qualify for a mortgage? Lower mortgage rates help borrowers qualify for a larger mortgage amount, and make it easier to pass the mortgage stress test, which requires borrowers to prove they could still afford their mortgage if their rate increased by 2 percentage points. To illustrate, let us take a look at a theoretical couple looking to purchase a home. Combined, they have a household income of $100,000 and have pulled together a 10% down payment. With a mortgage rate of 6.95%, these borrowers would qualify for a mortgage of $325,350. However, lowering their rate to 6.7% would allow them to take out a mortgage as high as $331,920. an increase of $7,300. Ultimately, lower mortgage rates will provide a small benefit to borrowers of all kinds, whether they are shopping around for a new mortgage, coming up for renewal, or exploring their refinancing options. Now let us shift gears and talk about a major development in the Canadian mortgage landscape. Nesto, Canada's leading digital mortgage lender, has announced the acquisition of the CMLS Group. This is a significant move, as CMLS is the third largest mortgage finance company in Canada. The merger aims to build what they are calling Canada's mortgage ecosystem of the future. This acquisition positions Nesto as the largest technology-enabled lender in Canada. The combined entity will now be a leader in both residential and commercial mortgages, boasting over 1,000 employees across 10 offices and managing more than $60 billion in mortgages. The transaction was backed by a number of high-profile investors, including Diagram Ventures, Portage, Naventures, which is the corporate venture capital arm of National Bank of Canada, IGM Financial, BMO Capital Partners, Fonds de Solidarité FTQ, and Fond Action. With such strong backing, the merger is set to make waves in the industry. Malik Yakubi, the chief executive officer of Nesto, stated, "This acquisition reinforces our commitment to delivering on our mission, to offer a positive, empowering, and transparent property financing experience simplified from start to finish to all Canadians." He emphasized that combining the strengths of both companies will allow them to better serve Canadians and set new standards in the mortgage industry. All executives and employees from CMLS Group will transition to the new combined entity, and CMLS shareholders will have an equity stake in the new organization. This seamless transition aims to maintain the quality of service and expertise that both companies are known for. Sam Brown, the chief executive officer of CMLS, expressed his enthusiasm about the merger, stating, "Joining forces with Nesto will accelerate our next chapter of growth and further help our people, partners, and clients succeed. I'm delighted to build on our proud history and reputation with a partner who shares our commitment to culture and delivering value to partners and clients." Established as a commercial lender in 1974, CMLS has evolved over the past 50 years into a leading lender, advisor, asset manager, and software and services provider across nearly all commercial and single-family residential real estate markets in Canada. They deliver these products and services through CMLS Financial, IntelliFee, and CMLS Asset Management. The merger promises to accelerate growth and innovation for both companies. Malik Yakubi will serve as the Chief Executive Officer of the combined entity, while Sam Brown will continue his role as President and Head of the Commercial Division. All existing brands, Nesto, CMLS, and IntelliFee, will remain intact. In summary, the acquisition of CMLS by Nesto is a monumental step towards creating a more integrated and technologically advanced mortgage ecosystem in Canada. With their combined expertise and resources, Nesto and CMLS are poised to set new standards in the industry, offering enhanced value to their clients and partners. Ontario has once again failed to meet its monthly home starts goal, according to new data from the Canada Mortgage and Housing Corporation. In May 2024, the province added 7,062 units, which is a 23% increase from the same time last year, but still roughly 5,400 units fewer than the monthly target of 12,500. In fact, Ontario hasn't hit its target once since 2022, as shown by the CMHC's numbers. To put this into perspective, a February 2022 report from Ontario's Housing Affordability Task Force said the province needs to build at least 1.5 million homes by 2031 to meet growing demand. That works out to 150,000 new units each year, or 12,500 per month. Unfortunately, the best performance was in September 2022, when 11,236 housing starts were recorded. Since then, the province has only once exceeded 10,000 units, in June 2023, with 10,114 housing starts. The historical data is not encouraging either. iPolitics QP briefing obtained Ontario's monthly housing start data from the CMHC dating back to 1990. Despite changes in government, economic ebbs and flows, and interest rate volatility, the province has never once hit 12,500 units in a single month over the past 34 years. Since winning a second term in 2022, the Ford Progressive Conservatives have mainly focused on spurring new home construction, saying it is desperately needed to end an affordability crisis in the province. However, the numbers show the government has failed to meet its own targets, and the CMHC is skeptical it will do so in the near future. The housing agency is actually expecting a decline in housing starts in 2024, with a slight rebound in the next 2 years. Ontario and British Columbia are expected to drive the decline in national housing starts for 2024, according to the CMHC's 2024 Spring Housing Market Outlook. The agency warned that high home prices will make certain home types unaffordable, and developers may struggle even with apartment construction due to supply-side challenges, particularly financing costs. Housing expert Mike Moffat pointed to a mix of factors both within and outside of the Ontario government's control. Ontario builds a lot of apartments, and they tend to be very sensitive to interest rates. So the global kind of interest rate hike we've had over the last couple of years has really slowed down construction, said Moffat, who is the Senior Director of Policy and Innovation at Smart Prosperity Institute and founding director of the Place Center. But some of it is policy, Moffat continued. The Progressive Conservatives have received both praise and criticism for their efforts to encourage new home construction. They have been lauded by some housing advocates for eliminating single-family zoning and committing billions to a new fund to help build housing-enabling infrastructure. However, they have also faced criticism for their handling of their now-scrapped plan to develop parts of the Greenbelt, and for backtracking on freezing developer charges and opposition to 4 units as of right. Moffat explained, "They opened up the Greenbelt to development, then reversed that. They froze development charges, and then reversed that too, under Bill 185. So we haven't really seen much improvement in provincial policy again, because there's been so much backtracking on the policy front." Housing remains a major focus for governments of all stripes in Canada. The federal Liberals outlined a swath of measures in Budget 2024 aimed at adding 3.87 million new homes by 2031. These include loan programs for apartment construction, infrastructure funding, opening up public lands for development, and tax breaks. Canadian home prices have surged in recent years and rank amongst the highest in the G7. Data from the Organization for Economic Cooperation and Development in 2022 showed that Canada's home price-to-income ratio reached 148.16, outpacing other high-cost countries like Germany, the United States, and the United Kingdom. A dire report from the Royal Bank of Canada earlier this year found that a Canadian making the median household income would need to spend 63.5% of their pay to cover the costs of owning an average home at market price. For opposition parties at Queen's Park, the Ford Progressive Conservatives are to blame for failing to take bold action to restore affordability in the housing market. Liberal member of Provincial Parliament Adil Shamji called Premier Doug Ford an obstacle to housing prosperity in Ontario that needs to be removed. The numbers from this month's CMHC report are part of a broader pattern of devastating inactivity in the housing sector since Doug Ford took office. He has done nothing but break promise after promise to homebuilders, municipalities, and to everyday people, Shamji said. Doug Ford's 1.5 million home promise was a hoax. New Democratic Party housing critic Jessica Bell echoed these sentiments, pointing to the province's failure to adopt 2/3 of the recommendations of its own task force on affordability. "It has never been more expensive to rent or own a home in Ontario," she said. "We have asked the Conservatives to take an effective approach to build the 1.5 million housing starts people want to live in, and their approach has been to waste billions upon trying to build the connections on the Greenbelt, and it hasn't worked." According to the province's own numbers, it has only fully implemented 28 of the 74 recommendations of its own housing affordability task force, with another 19 dubbed as in progress. The remaining 27 are deemed under review, though it is unclear if, like the fourplexes, as of right recommendation, that means they are not being considered. The Office of the Minister of Housing, Paul Calandra, would not comment directly on specific policy measures, but maintained the government's plan to build homes is seeing results, and blamed federal policies for dragging down home starts. The last 3 years have seen the highest housing starts in Ontario in over 3 decades. However, as a result of high interest rates and the high inflationary and high tax policies of the federal government, including the carbon tax, Ontario's home builders continue to face a challenging economic environment for building, a statement from Calandra's office read. At the same time, in order to address the infrastructure gap we inherited after years of underinvestment by the Ontario Liberals, we're investing over $3 billion in housing-enabling infrastructure, which our municipal partners have identified as the number one obstacle they face in building the housing our province needs. Housing expert Mike Moffat suggested that the province should look at its own tax situation to help speed up home construction. Taxes, he said, make up about 31% of the cost of construction, and lowering these costs would speed up housing starts. We've seen the federal government do things like eliminate the goods and services tax on purpose-built rentals, but the province hasn't done as much, he said. Among these taxes increasing costs are development charges, which municipalities use to pay for infrastructure and connecting new housing with municipal services, such as sewers and roads. Critics argue that these onerous fees are stalling new construction and driving up the cost of homes, which is problematic as the country grapples with an affordability crisis largely fueled by skyrocketing home prices and rents. Although these charges are municipal, they work under a provincial framework, so changing that may require the province to step in and compensate municipalities. I think this would be a game changer, Moffat said. He also suggested implementing some of the recommendations of the province's own task force, particularly the development of a municipal service model for things like water and wastewater, which he said would drastically lower development charges. This would make a lot of difference. We're seeing British Columbia, for instance, allow for mid-rise, single-staircase apartment buildings and things like that. It's a very European model, but it helps get mid-size apartment buildings built. Ontario should be looking at that, Moffat said. Moffat also flagged allowing fourplexes as of right as an important measure, though Ford has ruled this out, crediting the decision to push back from residents. Finally, Moffat said that the province should be requiring municipalities to use provincial population forecasts in their housing targets. It sounds like a small thing, but it's actually really important that municipalities over the last decade or so have drastically underestimated population growth, he said. Population growth, particularly among new Canadians, has also played a role in the housing picture, primarily by fueling demand. Migration was responsible for 98% of the historic 1.27 million increase in Canada's population in 2023, according to Statistics Canada. Moffat recently released data showing that some 70% of the demand for housing in Ontario over the last year came from newcomers to Canada. While immigration is a federal responsibility, a sizable portion of the demand is coming from temporary residents, namely international students, which falls under provincial purview. Moffat said all orders of government shoulder the blame for failing to plan for the historic increase in new residents and called for better coordination to ensure there is adequate housing and infrastructure to accommodate the increased population. No one order of government owns population growth policies. Yes, the federal government controls immigration policy, but until recently, they allowed provinces to decide how many international students to let in, he said earlier this month. As we approach the summer and fall of 2024, the real estate market in Ontario showcases a robust and dynamic outlook. The sustained demand for housing across various types and tenures continues to drive the market, supported by favorable economic conditions and a healthy labor market. Ontario's housing starts are anticipated to reach new heights this year. The strong demand for housing coupled with limited inventories has created a vigorous market atmosphere. Ground-oriented residences such as single-detached, semi-detached, and row homes are expected to see a modest increase in housing starts from 2024 to 2026. While the overall market remains active, specific segments show varied performance. For instance, the apartment sector faces challenges due to heightened mortgage rates and rising costs of materials and labor. This has led to fewer project initiations in 2024 and 2025, particularly impacting apartment starts. Despite these challenges, there is a visible shift towards suburban municipalities within the Toronto Census metropolitan area, where apartment projects are more feasible. The multiple listing service sales are projected to rise, particularly focusing on more affordable units such as row homes and condominiums. The average multiple listing service price in Toronto is anticipated to rebound in 2024, with continued growth forecasted for the subsequent years. This growth is attributable to the persistent demand and limited supply, which keep the prices buoyant. The rental market in Toronto is expected to remain tight, with vacancy rates for purpose-built rental apartments experiencing a slight increase over the forecast period from 2024 to 2026. Average rents for two-bedroom apartments are predicted to rise further as rental demand outpaces supply. This trend underscores the ongoing challenge of rental market affordability in Toronto. Given the complexities and dynamic nature of the Ontario real estate market, leveraging expert advice is crucial. Using a mortgage broker from Sherwood Mortgage Group can provide invaluable assistance in navigating this landscape. Allison Cosgrove from Sherwood Mortgage Group offers tailored insights and guidance to help you make informed decisions. You can connect with her and explore the options that can help you get on or move up the property ladder. Our final story today brings us to a shocking development in the Toronto real estate scene. A husband and wife law firm in Toronto is under scrutiny for allegedly embezzling millions of dollars from homebuyers' trust accounts. This case has exposed significant vulnerabilities in the home buying process that relies heavily on lawyers' undertakings and good faith. Nicholas Cartel and Singa Bui, partners of Cartel and Boi LLP, are accused of failing to pay off sellers' mortgages in at least 6 Southern Ontario home sales, despite receiving funds from buyers to do so. The Law Society of Ontario has provisionally suspended both lawyers and shut down their firm amid 15 lawsuits, claiming a total of $15.5 million in damages. According to lawsuits filed by 7 homebuyers, the firm allegedly took their money, paid out the home equity to sellers, but held on to the remaining funds meant for mortgage payoffs. This has left many homebuyers in a precarious financial situation, highlighting the risks involved in the current property transaction system. Anthony Ngara, a mortgage agent who lost over $310,000 in dealings with the firm, told CBC News, "The general public needs to know that their money isn't safe in a lawyer's trust account." In another case, Thierry Cohen-Scali, a Florida-based engineer, alleges the firm is withholding $465,000, meant to be returned to him after obtaining necessary tax clearances from the Canada Revenue Agency. Balvinder Kumar, a veteran real estate lawyer, highlighted the risks associated with wire transfers in property transactions, stating, "Wire transfer has become a norm, and that is very risky, because in spite of the fact that the lawyers are giving undertakings, it may or may not happen." Court and Law Society documents suggest the couple used clients' funds to pay their own mortgages, credit card bills, and business taxes. The judge described their lifestyle as fairly extravagant, with Cartel requesting monthly living expenses of $30,655. While Bui initially shouldered the blame for the missing funds, Cartel maintains he had no role in financially managing the firm. However, the Law Society's decision to suspend him states he appears to have misled another lawyer and failed to cooperate fully with investigations. The Law Society of Ontario has faced criticism for its delayed response to complaints about the firm. Despite reports of financial irregularities dating back to April 2023, an audit of the firm's bank accounts only began in late November. Cartel has repeatedly promised to make whole those who have lost money, but there is little evidence of follow-through. He is appealing his license suspension and claims to be in discussions with the Law Society about resolving his case, a statement the Law Society representative has flatly denied. This case underscores the importance of due diligence and safeguards in the home buying process to protect consumers from similar fraudulent activities. As always, it is crucial to work with trusted professionals and stay informed about your rights and responsibilities when engaging in real estate transactions. That wraps up our first episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for joining me, Steve Hamoen, as we navigated through today's pressing issues and developments in the mortgage and real estate sectors. Be sure to stay tuned for our next episode, where we will continue to bring you the latest insights and news to help you make informed decisions. Until next time, take care and stay informed.